Hello and welcome to today's Delta Credit Tip. Today is a fantastic episode. I can't wait to get this out. Today we discuss the Delta principle. Okay, you're ready to buy your house, you got the credit cleaned, you're approved, you picked your house, everything's great. Now we got to come down with a down payment. And your lender's telling you one thing, your realtor's telling you another thing. We're going to tell you the truth. And we're going to show it to you, and it's going to absolutely blow your mind. So stay tuned for today's Delta Credit Tip. Hello, welcome back to today's Delta Credit Tip. Super excited about today because today we break the myth. Okay? Today we're going to talk about the Delta principle, and we coined it that because I made it up. I can do that. Right? And today we're going to talk about that down payment on your house. All right. The thing about the down payment is it can affect a lot of things. It can affect your monthly payment. It can affect how long it takes you to pay off the house. It can affect how much you actually pay for the house. It can affect the insurance that you pay. It can affect all kinds of things. Okay. So today what we're going to do is we're going to spell out a couple of scenarios. Okay, and we're going to show you a different method. Okay, contrary to what you might hear, we're going to show you the numbers so that you can see the accuracy in it. Okay, remember, having good credit has nothing to do with your score. It has to do with the behaviors. And credit repair has to do with fixing mistakes that you've made. But good credit behavior is about going into these relationships with the right behavior and maintaining them with the right behavior. So what this is going to do is show you a better way to go into a mortgage than what you maybe have been previously taught. Okay. And the cool thing about this is that at Delta, this big red triangle that's our logo, it's a mathematical symbol, right? It's a mathematical symbol that represents Delta, which is a symbol for change. And the cool thing about it is that this does not require a whole lot of change on your part, but it will make a dramatic change in your mortgage. Okay? So, we're going to go to the computer, and I'm going to show you some numbers. Okay, so the first thing I want you to do is I want you to go, if you're going to follow along, that is, to go to bankrate.com. I like this website because it has a really good, what they call amortization schedule. So if you go to bankrate.com, this is the website. You're going to click on or run your mouse over mortgages and click on the amortization schedule if you want to follow along. Okay? So we're going to start off with a baseline scenario. We're going to give you 3 different scenarios, and we're going to manipulate the scenario so that you can see a better way of going into a mortgage. Okay, so we're going to start off with example 1 where you have a mortgage of $200,000. Okay, 30-year note, 4.5% interest rate, which you can see on the left-hand side. The rate of 4.5%, the stated rate, is really irrelevant to a certain degree, but the rate that you pay is really the foundation of it all, but the actual rate that you pay is irrelevant. The stated rate that they state is irrelevant. And I'll show you, if you follow along, you'll see. So in this example, $200,000 mortgage, your principal plus interest payment, which you see on the right-hand side, or kind of in the middle of your screen, $1,013.37. This is your principal plus interest payment, not your taxes and insurance. That's not included in there. And the mortgage, as you can see, is a 30-year note. So you're going to be done with this mortgage because I'm doing this in July of 2019. Your mortgage will be done in July of 2049. Okay? But the key here isn't the stated rate. It's the effective rate. So the thing about the stated rate of 4.5% is that you're really not paying 4.5%. You're actually paying, on average, much higher. So if you see right under the mortgage payment, the principal that you'll pay over the life of the loan may be $200,000, but the interest that you will pay over the next 30 years is $164,813.42. That's what they call the effective rate. In effect, you are paying that much in interest, and when you divide $164,813.42 by the $200,000 that you borrowed, you will see very quickly that the interest that you pay equates to 82.4%. That's ridiculous. But that's not, as much as it probably did blow your mind, not as big as your mind is going to blow. Okay, so let's look at scenario 2, because in scenario 1 we put 0 down, right? It's our baseline. But you may say, you know what? I don't want to pay that much interest, nor do I want to have that high of a monthly payment. And on top of that, I'm paying interest, right? I'm paying what they call private mortgage insurance because I don't have enough equity in my home. And that could add almost $200 a month in your note. So your lender may say, you know what? You don't want to do that. What you need to do is put 20% down to avoid the private mortgage insurance. It'll lower your payment and it'll reduce the amount of interest that you pay. And that is partly true, but not the whole truth. So let's move on to scenario 2. So you take the advice of your lender and you say, you know what? I'm going to put that 20% down. So 20% of $200,000 is $40,000. So you do that. And now your new loan amount is $160,000. Okay? Now, the thing about it is that your mortgage is still a 30-year note, right? So the mortgage is still going to be done in July of 2049, but because you put the $40,000 down, you're not paying the $164,000 that you would have in interest in the first scenario. You've actually reduced it to a much lower amount. And the payment, well, it dropped a whole whopping $200. You went from $1,000 and whatever it was to $810. So you dropped $200 a month. That $40,000 gave you an extra $200 a month, and you shaved roughly $33,000 in interest. Here's the kick in the pants, though. If you divide the $131,850.74 that you're going to now pay in interest and divide it by the amount that you actually borrowed, which is $160,000, guess what? You still pay 82.4%. What the hell? You really didn't change the rate that you paid. You may have changed the amount that you paid, but the rate is still the same. So now what we're going to do is we're going to implement the delta principle. And the cool thing about delta is that the mathematical symbol of delta, that big red triangle that's our logo, that's a mathematical symbol that represents change. And like I said in other videos, and I believe in this one, it doesn't require a whole lot of effort on your part to make a huge amount of change. And in this particular case, we're talking 24 hours. So instead of putting $40,000 down the day before you close, you put $40,000 down the day after you close. Well, what does that do to our new situation? Well, first off, it's going to bring your mortgage back to a loan amount of $200,000. The payment goes back up to $1,013.37. Okay. But now, as you can see here, we've added the $40,000 as a one-time payment after the mortgage is laid out. And now the mortgage, first you'll notice, is that the mortgage is done not in the same amount of time that the original loan was done. What you'll see now is the loan actually matures in July of 2039. So what we've done is we've shaved 10 years off our mortgage. And on top of that, if you notice the interest that you pay, the interest drops to $83,136.68. That should blow your mind. That is the delta principle. And if you really want to look at, well, what does that do to the rate that I'm actually paying, that stated rate of 4.5% and that effective rate of 82.4, well, now we've actually done something that's going to change that, okay? because now when you look at the fact that you're only paying $83,136.68 in the $200,000 that you borrowed, you realize now that your effective rate is 41.56%. Still a kick in the pants, but you know what? I can breathe and my eyes aren't watering now. So the question still remains, what about that private mortgage insurance, right? I don't want to miss out on that $200 or whatever I've got to pay my lender for private mortgage insurance. Well, the thing is if you're going into a mortgage situation, you're going to have to get an appraisal unless you're buying it cash, right? And in that kind of situation, the appraisal you've gotten probably within the last 30 to 60 days, and appraisal is good for a full year. So if 3 days ago there was an assessed value of whatever it is, and now I'm 3 days later and I've put that 20% down, well, I should have still reached that 20% equity, and that private mortgage insurance should be able to be cut out because the appraisal is still good. So you get the benefit of both the reduced amount of time on the mortgage, which is in this scenario 10 years. You shaved almost $40,000 off your mortgage, right? And on top of that, you also get the private mortgage insurance reduction. It's a win-win-win. Now, here's the thing. If you approach your lender, and we've tried this, we've tried to talk to lenders and say, hey, look, you've got my down payment. How about you just hold on to it until after we close and apply the money then? And they'll do that. But what they're going to want to do then is recast the loan. They want to re-amortize the loan. Why? Well, let's think about this. They want the interest. So no, I don't want to recast my loan. I want it to just go on as would have otherwise been scheduled, because the key to this theory, the key to this, the Delta principle, is that interest is irrelevant without time. By putting that principal payment down, because the way they calculate a term loan, that principal only payment that you make shaves the time off the back. That's why we went from 30 years to 20 on the loan. And as a result, as they do with all term loans, the thing is they always charge you interest on that same dollar year after year after year, and then they front load it to the front, so you pay all the interest up front. Well, if they can't go to 30 years, they can only go to 20, that's where you get the savings. That's why you can't recast the loan, and that's why you can't put the money down before you close, because it cancels out the interest. So when you go to your lender, you don't want to put 40% or 20% down. You want to put as little as you possibly can down if you've got the money, and then apply the money after you close. That's how you're going to pay off your house. That's how you make a choice. That's how you make a change. The Delta principle with Delta. So I hope this information helps. If so, give us that thumbs up. Don't forget to subscribe and hit the bell so that every Thursday when we come out with new information on things like your Delta principle, you get it right out of the gate. Most importantly, if you know somebody who's about to go into a mortgage and they're contemplating about what kind of down payment they want to put down, share this video, right? Share this with your lender. Share this with your realtor, right? So they understand the concept that you're trying to accomplish, and hopefully this will help you get to the end of that loan without paying out so much cash.